he knew a lot of shit, didn't he?
You guys want me to drop? I'm still here. You want me to drop off?
Yeah.
Oh yeah. Usually the guest drops off, and we just talk about futures, short-term trading stuff that you wouldn't be interested in. Yeah. Okay, I'm glad I didn't say anything bad about you.
Thanks again, Mike. Appreciate it.
See you. Okay, welcome back to the Futures Edge. I'm Jim Urio. As always, Bob Iacchino, who's the brains behind the operation and co-host. Today we have Mike Alfred, private investor, member of many boards, been around a long time. Thank you for coming, Mike.
Thank you guys for having me on.
So usually at the beginning of the show, we have our icebreaker round, establish credibility. What's your favorite movie?
Maybe The Fugitive.
No, I like The Fugitive. Set in Chicago as well. Okay, favorite actor.
That is a new one.
Yeah, it's an old one. So,
favorite actor. Yeah.
Well, let's just continue the theme. Harrison Ford.
I think that's a fine choice. Favorite band.
Oh man, this is tough. Let's just go with Led Zeppelin.
Okay, Led Zeppelin's good. All right, I think you passed all those very well. So thank you very much for being here. And we have questions. I went over your Twitter feed today. I saw you talk a lot about cryptocurrencies. The notion that realized 30-day vol in Bitcoin has dropped below the S&P, which is not, I mean, I know it's not, it happens on occasion. It's happened like 6 times in the last 8 years. But is that a big deal to you? And what's it telling us, the fact that both Bitcoin and Ethereum are just trading sideways?
So I don't really spend a lot of time on short-term movements, with the exception of the entertainment on Twitter, right? Because everybody likes to make calls and short each other, fade each other, and make fun of each other. A lot of shit posting going on Twitter. But in terms of like how I actually would invest in the space, it really doesn't matter to me at all what the volatility reading is on Bitcoin. I invest in Bitcoin for fundamental reasons. It's something I intend on holding for 10 or 15 years out into the future. And so, while it's interesting to some degree to watch the correlations change in this environment, right? And the most interesting correlation that broke down was this bond and equity correlation. I actually don't think what's going on with Bitcoin equity is really that interesting. But the fact that, you got people like Michael Gayed on Twitter screaming his head off that, if 20-year treasuries keep going down, the whole system's going to break down. And I actually think, this was sort of predictable. Like I was talking 2 years ago about avoiding bonds, like my mom and my aunt and my father-in-law, et cetera, whose portfolios I sort of advise informally. I had them 0% in bonds for the last 2 years. And maybe that was a little early, but in general, I just saw a lot of risk in that asset class. And so I'm not surprised at all to see treasuries down this much, but I know the guys that ran a back test on bonds versus equities are very disappointed with the performance this year. I think Bitcoin is more or less doing what it's supposed to do across time, and short-term volatility doesn't really kind of read in at all into my strategy or my thinking about the asset.
So so you say you're Bitcoin for 10 to 15 years. I'm in Bitcoin as well too. And I'm curious if the reasonings are the same. Are you in Bitcoin? Are you in Ether as well? Or are you in other coins?
I have a little bit of Ether that I bought at $300 in August of 2020 or 2019. I can't remember exactly the date, but it was in the summertime, late summertime, and it's something that I had been following for 3 or 4 years, and I never owned it. And so I just bought some sort of as a VC bet, but I don't think of Ethereum and Bitcoin as the same thing.
So is your Bitcoin strategy, is it a disaster play? Are you thinking that we are completely screwed economically and that's why you'd need Bitcoin? It's going to replace things?
I think that could be a component of why you would own Bitcoin. I think a lot of people do own it for that reason. If central banks fail,
that's why I own it. Yeah.
If you own Bitcoin in cold storage, it's the only asset you can hold that really has no counterparty, right? Because it's just you. It's just as long as you have your private key, you have access to it. So whether you're a refugee fleeing in Central Africa from some oppressive regime, or you're just somebody who doesn't trust the bank, the banking system, et cetera, then it's a good asset to hold. But I also think it's an interesting technology platform. It's an interesting new way to organize human society, right? It's something bigger than just an asset. And that piece is what gives it a lot more upside in the long run, in my opinion, because as you add new people to the Bitcoin network, the value should go up fairly exponentially across time. And we're just seeing that in the data, right? Like forget about the short-term price, the volatility, the correlations with other assets. Just look at how many wallets there are and how many people are holding at least, say, 0.1 Bitcoin across time. And that number is straight up to the right with very little variation. And if you actually take that data and you cut it up by region, or you cut it up by government or state or country, what you see in the data is that accumulation behavior is really, really consistent in places where there's monetary instability, right? So if there's high inflation, there's sort of a government that can't be trusted, that accumulation behavior happens independent of price. Now in the Western world, the US, Europe, et cetera, you do see more of a correlation in terms of holder behavior tied to the price. So when the price goes up in the US, right, I think December 2017 or November 2017, everybody was at Thanksgiving, everybody was talking about Bitcoin. Price peaked near 20,000 and fell all the way back down to 3,000. Same thing happened last November, peaked at 69, whatever, and we're back at 19. But if you look at the behavior, as you can sort of suss that out from addresses that have done peer-to-peer transactions in like places like Nigeria or Argentina, et cetera, it's completely independent of price. And I think that part of the thesis is really important. Yeah.
Because there's this prince who I've been talking to who seems like he's in a lot of trouble, who I've sent some Bitcoin to. Have you guys talked to him at all or no? Anyway, so Bobby, I want one more question, and then I'll pass over to you. But just in the last 2 weeks, Google announces they're going to accept Bitcoin for cloud storage. Bank of Mellon takes on custodial services for Bitcoin, the oldest bank in America. JP Morgan hires a big name regulator. There was one other headline. Oh, Japan changes some rules and regulations to make crypto startups more welcome instead of less, which, by the way, it just blows my mind sometimes that governments, it seems like it's cutting into their game. It seems like they would have squeezed them out a long time ago, but they let them grow, and now they can't. But anyway, those 4 headlines just in the last 2 weeks, when you see that, that's got to be, how encouraging is that as far as the broadening of the adoption argument?
To be honest, I mean, the drumbeat of good news has been going for 4 or 5 years, right? Pretty much uninterrupted. If you look at like Travis Kling on Twitter, he'll post every month the list of big announcements, and there's like 50 every single month. And I would say the 3 or 4 of the ones you just mentioned wouldn't even make his list almost, or maybe 2 or 3 of those would make his list in a given month. And so if you really pay attention to the space, it's an uninterrupted straight line in terms of adoption. And so none of those gave me any particular kind of bullish sentiment, but I'd say collectively, when you look at all the news flow across multiple years, and then again, you go back to the data and you look at the actual adoption, you can sort of ignore the price in the short term, because obviously there's macro headwinds that have nothing to do with crypto adoption.
Bobby, what do you got?
Yeah, so a couple of things. So first of all, I want to throw a disclaimer out there. I'm a believer in Bitcoin specifically and crypto in general. But admittedly, I'm a believer almost for the same reason that I believe in God, because I'm afraid if he's there, he's going to be pissed if I don't believe in him. Bitcoin's similar to that because I just don't know enough about the technology. So I want to, it's going to seem like pushing back, but I'm not. I'm more asking a question. When you say there is no counterparty until, well, let's just take some of these regimes, like we'll take Nigeria, it doesn't matter to me, Venezuela, whatever. When you can't exchange in a day-to-day world, when you can't exchange it for goods and services, doesn't adoption matter? Or is that more of a short-term worry that I would have as somebody who, has owned crypto in the past and plans to own it again? Because you kind of have a counterparty, right? Until it's fully adopted.
What I'm saying is when you're holding it, there's no counterparty risk, right? So if I buy $1 million of Bitcoin right now and I put it in cold storage, the price can go up and down. If I choose to do business with an exchange to buy or sell, there's obviously counterparty risk at the moment that I transact. But the moment that I take that $1 million of Bitcoin off of the exchange and I hold it, now there's no counterparty. Now, certainly if you want to use that Bitcoin in real commerce, you may need to have an application of some sort. You may have to have a front end. You may have to have some sort of web app or mobile app, or you may need to interact with a layer 2 like Lightning Network. But I'm more concerned with long-term storage of wealth and being able to hold an asset that I don't think could be debased, that I don't think could be taken away from me, right? Where the rules won't be changed. It's a rules-based system, right? So we can just look at the algorithm, we can look at the code, and we can tell you how many Bitcoin are going to be emitted over the next year, over the next 5 years, over the next 10 years, et cetera, right? And it's worked basically as advertised from the beginning. And the important thing to understand about Bitcoin is this sort of rough consensus between the nodes, right, and the miners and the users, in the sense that, yeah, there are certainly like miners every 10 minutes approximately are sort of confirming those transactions, but even the miners can't push through transactions that the nodes don't confirm. So it's
can you tell us what nodes are real quick?
Nodes are just the people that are running the sort of the Bitcoin software.
Okay.
Right. So they're running the code, and they're able to see all the transactions, right? They're able to confirm those transactions. They're essentially keeping a copy of that ledger. And so the ledger is stored across these tens of thousands of nodes all over the world. And so one node can go down, it's permissionless, right? So one node can come on, like you and I could spin up a node tomorrow. We could run it for a year and then decide we don't want to do that anymore, and we shut it down. But the benefit of running it is you can then confirm your own transactions. You can confirm your own balances, right? So you can literally do a check function right in your own sort of software, and you can check and see how many Bitcoin are in the wallet that you have the private key for, which is how you control it. And so, Bobby, back to your question, I mean, as long as you're not transacting with your Bitcoin and you're holding in cold storage, there's literally just between you and the blockchain itself. And again, that blockchain, because it's not controlled by any one party, it can't be rewritten by anyone, at least not very easily, without a tremendous amount of computing power. You could be pretty certain that in 10 years, those coins, which are really just what we call UTXOs, right? They're really actually just block space, right? They're just space on a limited, limited space on a finite blockchain. But we call them coins, right? Because it mirrors our sort of terminology from the traditional monetary system. So again, if you go to transact, right? So what would happen is you would cross a border. Let's say you're in an oppressive area. You store your private key in, say, a 10 or 12 or 15-word type phrase. As long as you remember that phrase, right? Duck, Roger, airplane, et cetera, then you actually, again, have full control of your keys. And if nobody else does, then you're the only person that has control over being able to use those. So once you show up in Switzerland, you could go to a Bitcoin broker and say, hey, I'd like to transfer some Bitcoin into your account so I can get access to a Visa card that I can use to spend against a portion of that Bitcoin, right? So you could transfer it to a new wallet that's custodied by this financial institution, and then they might issue you a credit card that you could then use. The point is that you could decide how to deploy any of the capital you've saved, right, to do real world transactions, and nobody could disrupt, your thinking around that and your ability to execute.
I feel with
a quick
everything,
question.
This is a weird thing. I've never had this before because, I've never really interacted that much with Mike. I've just kind of watched his Twitter and stuff, but I feel almost a need to disclaim almost everything I say from a perspective of, so I don't dismiss short-term moves in anything, including my traditional investing. So for example, I've been out of stocks for a while. I'm starting to get back in, even though a lot of it is long-term. I like to use my own skill set to possibly, put up a little alpha here. And I'm very public about having sold all of my crypto in March. And I'm getting all these pats on the back, and I hate them because it's not why I did it, right? It's not any sort of endorsement of the long-term value. My long-term target, and by that I mean less than 2 years for Bitcoin, honestly, is about 200,000. But I feel like I can get back into it at probably closer to about 9,000. Now, having said that, my sort of theory of that is stable coins have to get out of the way for the most part, especially this Tether situation, which admittedly concerns me, although I probably don't know enough about the details to be that concerned. And number two, I want regulation the fuck out of the way. Figure out how you're regulating it and let me know what it is, so I can realize how much that matters to my overall thesis or not. Do you put any of that, or do you give credence to any of what I just said? Or am I just an idiot that's still just a traditional investor? And be blunt.
Yeah, you're not an idiot, but you are doing short-term market timing, and that can work out really well when it works, and it can be very disappointing when it doesn't work. What tends to happen is people think they can call the top or the bottom on an asset like this, and then they miss it a little bit, and then they watch it go the other way for a long time. And all that I think matters is how many Bitcoin do you have when you get to 200,000 per Bitcoin, right? And so if you have more Bitcoin at 200,000 because of all the trading that you've done, good for you. But statistics, as you know, say that most people won't be successful at that. So you may be one of the ones who is, and I have no idea whether it goes to 9,000 or 12,000.
I'm going to push back a little bit on one thing that you just said.
Go ahead.
And it just not that I don't think Bob's not an idiot. I just don't think you have enough data on that. You just met him today, right?
He's basically calling me an idiot, Mike.
No, I'm not. I'm just
for the
saying
course. Par for the course.
But I do have a real question too. So I buy Bitcoin. I don't trade it. I don't time it. I buy it every Wednesday. I have it for years.
Mm-hmm.
Just in my Coinbase account, I purchase it on a regular basis. I consider myself someone who basically mistrusts people in power. I mistrust the Fed. I think mistrusting the Fed is consistent with my research on them over the last 35 years in the business. Do you consider yourself someone who's a mistruster of people in general? Is that what's led you to Bitcoin or no?
I don't think that was the starting point, but I have had questions about the Fed's behavior since 2007, 2008, 2009. And I think it's interesting in all of our political discourse now, we talk about like what the politicians have done in the last year, but they don't talk about this sort of creeping amount of intervention in monetary systems that have happened over the past several decades. I know it goes back further than that, but it really seemed to accelerate after the financial crisis, 2008, 2009, because we came to this conclusion that we could just bail out any industry. I remember people saying back in 2009, it's like we're just giving the drunk more alcohol, right? We never really had a market clearing event then, even because we sort of bought our way out of it. We saved a bunch of the banks, we saved the auto industry, right? We printed a lot of money, we lowered rates. And so now we're just in this sort of like perpetual cycle of doing that. I don't even know if it's necessarily nefarious. I think a lot of it is just like not understanding the long-term implications or just the political nature of things, which is that, politicians get reelected every 2 years, 4 years, whatever, right? And these monetary changes kind of proliferate over 5 or 10 or 15 years. Like we're still dealing with some of the negative impacts of money printing and debt that has happened 2 decades ago. And so it's not that I don't I think everybody at the Fed's probably doing their best, but I think the institution of the Fed itself is sort of fundamentally doomed if you believe in a free market economy and you believe that rates should be set by the market, right? And that if businesses fail, they should be allowed to fail so that capital can go to a more productive use in the future. We've got all these zombie companies now because of low interest rates. And so through the process of trying to save people, right, to make the economy better, we've actually made the economy less anti-fragile, right? We've allowed more of the wrong perverse behaviors to proliferate broadly. So to me, Bitcoin is sort of an antidote to that. It's not because you necessarily have to hate the Fed or distrust it. You just know that it doesn't work in the long run. And so to me, it's irrelevant who the Fed chair is or what they're saying or doing today. What matters to me is like over a long period of time, 20, 30 years, how am I going to maximize the value of my savings? How am I going to maximize the value of my capital? And I think in a portfolio right now, you don't have to have 20% of your portfolio in Bitcoin or 80% like some of these millennials who think that your entire portfolio should be crypto. But I think it's sort of like, I would say it's a really bad decision to have less than say 1 to 3 to 5% because of the asymmetry of it, because it is an antidote to a lot of the federal, and the Fed money printing and low interest rates, et cetera, ZIRP.
Okay, so you're not someone who's 100% Bitcoin then. Okay, good. You're not like one of those crazy lunatics who just think that that's the only game.
No, I talk about Bitcoin a lot on Twitter because it's one of the most interesting things happening in the entire world.
Great.
It's also one of the biggest audiences you can have. Before I started talking about Bitcoin, I had like 3,000 followers on Twitter. Like I think in June of last year, I had like 5,000 followers on Twitter. And I knew a lot about Bitcoin. I just didn't talk about it that much. And so when I started talking about it, like middle of last year, it was just timing, right? I was talking about Celsius and BlockFi blowing up, and I was talking about why you should have Bitcoin in a portfolio and how you compare Bitcoin with dividend paying value stocks, which by the way, going to Q3, Q4 last year was a really good decision. Like I was talking a lot about value names, not growth names. A lot of Bitcoin investors also want to own Shopify and Netflix and Carvana and Facebook. And I've always eschewed that. I've always felt that Bitcoin belongs in a value portfolio, not a growth portfolio, if you really understand what it is in the long run. And you can actually pair it with CVS or Bristol Myers Squibb or Merck or an energy stock, and that actually is going to have a better it's going to be a better portfolio than a portfolio full of growth stocks in Bitcoin.
Bobby?
Yeah, it's funny. That's something that I kind of wanted to ask you about, because again, you're kind of known for Bitcoin, but if you could, can you explain one of your tweets to people who probably didn't understand it? One of your tweets on October 14th, inflation in Turkey, 83.4%. In Argentina, 83%, USA 8.2%, inflation in Bitcoin, 1.8%. Can you kind of go into the math behind that for people?
Sure. I mean, look, it's sort of playing games with the definition of inflation, right? You'll see a lot of people argue about price inflation versus inflation in the monetary base, et cetera. But the reality is, price inflation, it doesn't really matter. Like, it doesn't really matter to the consumer. Like, if they're experiencing 8% price inflation, they don't care how much money was printed, because the net result of that is that their milk is more expensive, and their energy is more expensive, and their housing and healthcare is more expensive. And so we're in an inflationary environment now. Everybody can feel it. In the US, we've been relatively lucky, right? Like, if you've lived in Argentina or Lebanon or Central Africa, right, over the last 20, 30, 40, 50 years, you've experienced multiple bouts of high inflation. Venezuela is a good example. And in those countries, you can literally wake up one day, and at least in dollar denominated terms, like, most of your wealth is just gone. Like 50% of it's gone in a morning. Like, the whole market reprices. And so, look, nothing is really priced in Bitcoin yet, but you can imagine a world where if Bitcoin was the unit of account, right, for everything. So literally every car, every house, every financial asset was priced in Bitcoin. The actual monetary inflation in the monetary base right now for Bitcoin is about 1.7, 1.8%, right? It's 6.25 Bitcoin approximately every 10 minutes, about 900 a day, approximately, again, because sometimes the block times run longer or shorter. That's going to get cut in half sometime in the early spring of 2024. So then it'll be about 450 a day. And then 4 years after that, it'll be cut in half again to 225. And so what's happening in the monetary base of Bitcoin is that inflation rate is asymptotically approaching zero over the next approximately 118 years. So in the year 2139 or 2140, approximately, depending on, again, these block times, if you stretch them out over 100 years, those averages matter. And we're actually running a little bit faster than 48 months for each halving right now, because on average, miners are finding blocks faster than 10 minutes across multiple years. So what you're seeing with Bitcoin is that it really does have, again, if everything was priced in Bitcoin and everything revolved around it, it has the lowest inflation rates, now below gold. It's going to go lower, again, as long as the software continues to operate and the nodes continue to run and the miners continue to confirm those blocks. You can be very confident in the sort of inflation in the monetary base for Bitcoin. The counter argument to that, and the thing that a lot of the haters will say is, well, but if you held Bitcoin this year, Bitcoin's down X% in USD terms. And that is true, right? It is down in USD terms year to date. But if you look back on any rolling kind of 3 to 5 year period, Bitcoin is sort of crushing everything. And I think a part of that is its systematic scarcity and the lower and lower inflation rate in the monetary base that happens across time.
So, how do you feel about precious metals, Mike?
What was that?
How do you feel about precious metals? Sorry, John.
I think as a small percentage of a portfolio, like, most people should probably have a little bit of gold. At one point, I traded silver years and years ago. I think, given where the world is going right now, everything's being digitized, and young people are showing a distinct preference for digital assets over physical assets. They just can't imagine holding a gold bar. They don't know what they would do with it, how they would use it. And so I'm not one of those people who thinks Bitcoin necessarily replaces gold directly, but I am one of those people who would rather hold Bitcoin than gold, all things being equal, even though I don't think gold's necessarily a bad asset to hold.
So how much of your investing is a macro picture? How much are you concentrating on the Fed? How much are you monitoring when you think the Fed moves to neutral, when you think the Fed moves back to easing mode sometime next year, whatever? Do you base investments on that as well, or is that something you don't care about?
It's not that I don't care about it. I enjoy analyzing it. I enjoy reading the best experts on it. I enjoy being aware of what's happening across, the full cycle, but mostly just because I want to know when there are going to be opportunities to buy companies and sectors that I am interested in. right? And so like I was loading up on consumer staples in 2018, for example, right? Because nobody wanted those names at that time. Like you could buy Pepsi and P&G briefly for under 20 times earnings, but it was very, very short time frame to be able to do that, right? Same thing in 2019, like nobody wanted healthcare, nobody wanted energy until 2020, right? And so what I've noticed is these cycles kind of go in and out of, these industries go in and out of favor across time. And so if you're industry agnostic, as I am, and you're very patient, almost sort of every 5 to 7 years, one of the industries you'd like to own more of all of a sudden is extremely cheap relative to history and relative to the rest of the market. And so I don't really care so much about like, hey, when exactly does the Fed pivot, and when does the SPY start to go up, or when does the TLT bottom or whatever. Those are interesting things. I have them all on my watch list, but I'm more basing my investments around fundamental factors. Like I want to buy great companies that normally trade at 25 times earnings. I want to buy them when they trade at 15 times earnings for some usually idiosyncratic reason, right? I want to buy it because the whole industry is either out of favor or because something specific with that company went wrong, but it's a short-term issue. Like if you remember Chipotle back in whenever that was, 2017, 2018.
We talk about it all the time.
There's all these norovirus issues. I was watching that company like a hawk because I thought, hey, broken growth story, but clearly a really high quality business. I had a limit buy order in on that for like 1,000 shares at $200. And as you guys probably remember, it dropped from whatever it dropped to like 250, 248 or whatever, and turned around and went up, and I missed it. Right. But that's a perfect example of the type of situation that I get interested in. I bought Target when everybody thought Amazon was going to put Target out of business. I bought CVS when everybody thought Amazon was going to put CVS out of business. Right. Again, I bought some consumer staples names I've always wanted to own for like 10 years. I finally bought them in 2018 because the market hated those names for whatever reason at that time. And so again, more interested in sort of industry specific factors and then company specific than I am in sort of broader macro, although I enjoy pontificating on macro on Twitter.
So
nice.
If I could, Jimmy, I'm sorry. So here's like part of
no problem.
One of the things that I do, and Chipotle is a phenomenal example of it. So we have sort of an internal price action team, of which I'm a member of that team, and I'm not the best one. So I was still living in Chicago when the Chipotle thing happened. And I remember driving down Monroe. There's, Jimmy, you'll know there's a Chipotle on Monroe there. I think it's Monroe and Jefferson or something like that. And I'm driving down, and literally right after people started, dying and vomiting, I'm joking, obviously, from their food, there were still lines out the door. Mm-hmm. And my partner, Mike Arnold, who's on this podcast every single Friday because he's one of the best price action analysts you'll ever meet. I called him. I said, I want to buy Chipotle. And he said, we can't yet. And so then about a week later, I'm like, how about Chipotle? No, we can't yet. We can't yet. And our sort of theory on this, and it's something that I've applied to crypto, is I would rather miss 10, 15% of the move up to catch it on its way up rather than trying to pick a bottom. So Chipotle is a good example. One day, my partner said, we can buy Chipotle now. And it had actually come off the bottom. And I would say that, your bid for $200 for 1,000 shares kind of related to my bid at about 260 for, let's just make up a number, 350 shares, something to that effect. And it's the same thing to me when somebody asked me when I was getting back in Bitcoin, my answer, this was on a TV interview, my answer was, I don't know, but I'd rather miss the bottom and then buy it at 19,000 and have it go to 9,000 because of the way we allocate risk. Does that make sense to you? It's just not something you do, or you just think the data for you at least isn't there for that kind of an approach?
It's a trader mindset. And I've talked to great traders, and that's always what they say. Why would you want to ride the last 10%? I'll wait until it goes up later. And I just, again, it's worked for me. I've been investing this way for 20 years. I just buy things when they're in my fundamental windows. Sometimes I leg in, sometimes I buy the whole position right away when it hits my target, and it's worked fine. It doesn't mean I don't have any red in my portfolio. From time to time, I do buy too early, and obviously could have waited longer, but the vast majority of the time, the opposite would have been true as well. I might have missed it completely or had to pay a lot higher price. I think on net, what matters more is like, what do you hold in size for long periods of time, right? Period. And so like whether you got 19 or 15 or 12 on Bitcoin or 40, if Bitcoin ultimately goes to 200, 300, 500,000 across 5 or 7 years from now, the biggest mistake you can make is getting too cute on the entry price or too cute on trading in and out. And I don't think it will matter that much, to be honest, whether you paid 19. What matters is, did you buy 10 or 50 or 100 Bitcoin, right, at those prices, or 1,000, right? And if you bought in those larger sizes, then you could have, like Michael Saylor will be fine because he's not selling. So if he's right, it's just a light switch. Like if he's wrong and Bitcoin fails or goes to zero, then he's going to lose billions of dollars of mostly, money that came from convertible notes. So somebody else will essentially lose the money, and he'll destroy his equity value of the company. But if he's right, then it sort of doesn't matter whether he paid 28 or 31. He owns 130,000 Bitcoin. So he's going to be one of the wealthiest people in the world if it works. So again, nothing you're saying is problematic. The great thing about markets is that there's room for all different approaches and styles. There's traders, there's fundamental investors, right? There are people that are using leverage. There's people that are shorting. There's people who never short, right? There's people who care about single securities. And then there's people who mostly index. Like, I'm fine with any of those things. What I do is kind of unique, and I cut across private and public markets, right? So I seed companies that sometimes get big. And then I also am on a publicly traded board, and I've done activism work. I've done a 13D campaign on a public company, right? And so I see the whole spectrum from seeding companies, getting into the growth stage, doing the IPO, and then post IPO governance. And I try to pair my thinking on public equities. I sort of think of it like that. I'm much more like, there's a few different investors that I admire, but they're usually more active, right? People who aren't afraid to take a single digit percentage of company and take a board seat. And so I tend to not even buy stocks as a trade unless I would be willing to sit on the board of the company. And so that means it's a slower approach. It's more concentrated, right? And it's more thinking about it as a private equity investor as opposed to as a trader.
One of the things I rail against, especially in new equity investors, and Jim and I grew up in a world where catching a falling knife was the worst thing you could do, right? That's just was our phrase on when we both started on the trading floor. That's where we know each other from. But what drives me nuts is when you hear somebody say, I bought, I don't know, pick a stock. I bought McDonald's at $34. I'm gonna sell it when it's at 38. And then it drops by $10 and they're like, it's okay. It was a long-term investment. It's like, no, it wasn't. It was one or the other. Where you bought it, you had a thesis, and now you change your thesis based on where it went. And that's not something you do, which I really appreciate.
And that's what beginners do, right? Yeah. And so people who don't have a strategy or don't know what they're doing, they're playing around. And that's what we saw during the pandemic. Everybody was armed with their mobile phone, the pajama traders and their Robinhood accounts, and they were trading in and out of GameStop and AMC and Dogecoin and whatever. And I actually looked at GameStop in like 2018 or 2019. At one point it was like $3 or $4. I looked at it because it kept showing up on value screens. And I literally couldn't understand why I would own it. It looked like a shell of a real business. And so I had no regrets when it went to 200 or 300 because it was never something I would have owned. It doesn't fit my fundamental style at all, no matter how much it looked like a low multiple of earnings. I'm not interested in cigar butts, right? I'm not interested in like deep value where there's no catalyst or there's no growth opportunity, right? Like I like high quality companies when they trade at lower prices. And I think that I
hate when someone uses slang I don't understand. What's the cigar butts reference?
You don't follow the fundamental invest, like the deep value. Yeah, like back from the Benjamin Graham and Dodd days, like the guy who basically like trained Buffett, like the early formulation of value investing from like the 1930s was buying these companies where they would trade at like 2 times earnings, right? And the idea was, can I own this company for at least 2 years? Because if I get a third year of earnings, that's my return, right? Because you get all your money back in 2 years. And so cigar butts are just these things, like you imagine a cigar burning out on the street and you just watch it burning, but as long as it burns long enough, right, you get some value from it.
Okay. Bobby, you didn't understand that reference, did you?
I'm gonna act like I did.
Okay, good. Yeah. Okay. You talked before about sectors that are out of favor. Do you think are there things that are attractive to you now that are out of favor?
Yeah, absolutely. And I'm actually I have a anchor investor actually to start a fund. I've been meaning to start a hedge fund for 20 years, but I kept getting sucked into entrepreneurial stuff. And now I'm such an active corporate governance guy that keeps me too busy, but I'm going to step back from at least one of the boards that I'm on to make a little bit more space. And I'm going to start a small fund. And part of the thesis is that, Bitcoin and Bitcoin adjacent companies right now are extremely cheap, in my opinion. I think that'll be very obvious in 2 years from now.
Right.
And so I want to take a slightly larger swing at some of those things. So for example, energy companies related to Bitcoin. So these companies that are developing energy assets or data centers to kind of serve the Bitcoin ecosystem. Again, if Bitcoin works, some of these companies are going to be quite valuable. And right now they're trading like they're all going to go to zero, which is really interesting to me. So that's one sector. I still think healthcare is kind of largely unloved, even though like a bunch of these pharma companies are up year to date. So like I own a lot of BMY, I own a lot of Merck. They're both very positive. Vertex is also another. They're one of the biggest constituents of the IBB, and I think the XBI ETFs. But those companies are up a lot, but in my view, they're still somewhat cheap. Here, let me look. I'm looking for any other kind of sectors that really stand out to me. I mean, I would say those two are my two hot areas right now. Like I would say energy was there a year or two ago, but now some of these energy names have doubled or more off the bottom. I'm not sure, especially on the producer side, I'm not sure that those are necessarily good values anymore, because if the oil price goes down, the profits aren't going to be as real. I do like the MLP sector still, though. I like sort of the income oriented names in that sector where you're not taking as much direct commodity risk. I think that if you can get something for a 7, 8, 9% yield, that looks pretty safe. I still think there's value in those names.
You think there's
I'll ask one more question.
You think REITs are going to be positive soon or negative, or how do you feel about REITs in general?
It depends on the sector. Obviously, there's been a fundamental change in the importance of residential versus kind of office.
Yeah.
That's something I called out, by the way, on a podcast in April of 2020, like long before most of the commentators were talking about that. I have it's on Stuart Alsop III's podcast. I'm forgetting the name of his podcast, but I actually spoke for 20 minutes specifically about this. I hadn't heard anyone else talk about it yet because I was still formulating. It was like weeks after the economy shut down. But it was clear to me then that like we were never going back to like a downtown central district with a lot of office buildings. Like people just were not going to tolerate that. That said, like some of the industrial use buildings are actually more valuable. So even if they're not being used for a specific purpose, sometimes you're seeing these like transportation companies, like these people that are doing self-driving trucks. They need these depots just outside of downtown, right? And so they'll buy land and office buildings, even if they have to completely change the use case. I'm actually selling a building in Chicago right now. I'm a board member of a company that I'm the chairman of a company that owns a property in Chicago, and we've been marketing it. It's interesting to see who is interested in buying that property. It's right off the freeway, like 15 minutes outside of downtown Chicago. So I think like REITs are probably going to be under pressure just broadly because of rates, right? And we're already seeing that. And because real estate takes so long to reprice, I think we might still be at the sort of early stages of repricing. And the residential side, that's very clear that that's happened. Like in Vegas, prices are down 10, 15% off the highs for sure at the high end. I see the markdowns that are happening in these gated communities in Vegas, and I'm sure it's similar to what's going on in Austin and Nashville and some of these other hot markets. So I think it just depends, right? Like in the long run, I don't want to own office. Residential real estate is fine, but it was very expensive, and it's still very expensive relative to rates. And so REITs would be near the bottom of the list of where I would put new money right now.
Gotcha.
So there's selfish reasons I'm asking this question too. I gave a speech last week at the New Orleans Investment Conference, and this is a very, very simple thesis, but I want to know your opinion on it. The copper market, copper's just been destroyed because rates are going higher, because China is instituting its kind of scattershot lockdown policy, and at the same time, we're going through this decarbonization phase, which we're going to electrify the hell out of everything or whatever. So it just seems to me that the copper market is tight as hell, and over the next 5 years, I think it could be the next big idea. Is that kind of a way you like to think about things too, or is that a little too simple?
I don't think the best theses have to necessarily be complex. But that particular thesis doesn't ring any bells for me. Like it doesn't hit any spots that are compelling, right? Like,
yeah, sure.
usually when there's, even if it's a simple thesis, like there's something in that formulation in 20 seconds that at least catches my attention. It's just hard to be extremely bullish on sort of growth broadly in the economy when the monetary base is going to start to decline and the cost of money is going up and sort of liquidity is being withdrawn. Doesn't mean there won't be assets that perform well or businesses that outperform the average, but copper seems like a direct proxy for growth, right? And I'm just not bullish on growth. A lot of the stuff, like one of the big positions, I've only added 2 full size positions this year. The first one was enterprise products, the ticker's EPD. I tweeted about it on like January 3rd or 4th. I bought my first part of my stake at $22.48. It's at like 25 right now. It had a little bit over an 8% yield. I really wanted to be long natural gas. I foresaw that companies like Cheniere would be liquefying it and shipping it to take advantage of the differentials. Obviously the geopolitical issues we've had have actually been helpful to an extent because there's a higher demand for US natural gas. And I think it's very clear that we have natural gas needs in this country for 20 or 30 years. And so I like toll booth type businesses that touch that. That's been a good bet. And the only other new position I took this year was Icon Enterprises, the limited partnership of Carl Icahn, the ticker's IEP, was buying it at a 16% yield. It's at a little under 15% now. The thing about the structure of IEP that people don't understand is the reason why the yield is actually sustainable is because Icon himself owns close to 90% of all the partnership units, and Icon doesn't take cash as a distribution. And so the distribution looks like a 2% yield to the CFO, right, when he's thinking about cash flow outlay. And they have enough cash to pay that current yield for like 10 years, not including the hedge book that Icon runs, right? The concentrated nature of the positions, which he was very early to transition into energy when nobody understood why you'd want to own energy stocks in 2019, 2020. What was Uncle Carl doing? He was buying energy stocks as a good contrarian value investor would. And I'm confident in the succession plan because I think his son Brett has kind of learned how Carl thinks about markets. And so the capital allocation there should be good for the long run. So why do I own it? Because if I can get a 15 or 16% cash yield, then I don't really need a lot of growth anywhere in that portfolio. I just need enough cash flow to continue to service that. And so I just like the deal that Carl's just giving you a deal to own, to ride along with him and participate in all of his economics. And I think that's going to be a really good return. And just for people who look at this and say, well, I'm looking at the chart and it's not moving. Well, remember, the chart doesn't show the 15% yield because that comes right out of the price. And so when you look at the chart of something like IEP, it has a really nice chart, but it's not showing that between 2000 or so and 2020, Icon actually did 19x, right? Berkshire did 5x. So it almost 4x'd what Berkshire did in that time frame. And a lot of that is the benefit of just a consistent 15% or so cash return to the investors.
Yeah, I don't care if the chart is straight across the line.
And so I like stuff like that in this environment because it doesn't require you to be a genius and pick exactly what's going to work and what isn't going to work and try to guess things in the macro, the macroeconomic outlook that are impossible to figure out. And some of the stuff is reflexive. So even if you knew for sure what would happen, if everybody moved to align their portfolio to take care of what would happen, it would actually change what would happen. Sure. Right. And so like it is deterministic, it's path dependent, and it's reflexive. And so there's just anybody who tells you they have any idea what's going to happen. I like to swing at high expected value type of opportunity. So something like IEP, you're going to struggle to lose money over 5 years because you're getting 15% sort of locked in on the cash side. That's your yield on cost on day one. The units need to go down more than 15% a year, right? So the price right now is $53. It needs to fall 15% a year for 5 years.
Sure.
Otherwise, you'll have a positive return. And it just so happens year to date, the units are actually up 2%. So far year to date, you've gotten your first 3 distributions. So you've gotten whatever it is, close to 11, 12% already paid out in cash, and you're looking at a positive return on your underlying position. I like that, Matt.
Tell them the good part, Mortimer. Yeah, I love that. Yeah. That's awesome. Is there anything that, Bobby, this question to either of you, is there anything that we're missing that you wanted to talk about or we wanted to hit?
The only other sector that we didn't talk about is just the finance and kind of financial services, like non-Bitcoin related stuff. I mean, the banks are pretty cheap if they don't go away. I mean, the banks could end up being cigar butt stuff.
Or implode, rather.
Right. Yeah. I mean, like, look, from a capital standpoint, the banks are a lot safer now than they were, right, in 2007, 2008. And so all of that, all the learnings from the financial crisis combined with all the regulation, et cetera, have made the banks safer. The question is, are they safe from disruption, from fintech, from Bitcoin, from crypto, et cetera? And I don't know the answer to that. So I own State Street, Bank of New York, and Bank of America for several years. And they did fine, right? Especially with the dividends. They look cheap again right now. JP Morgan was trading at $101 or $102 the other day, a week or two ago. I almost bought some at that level, but I just can't get excited about owning financials even at these prices. I still own Prudential, right? And I still own Blackstone, but I bought Blackstone in 2016 at $25. So like, it's almost like another lifetime ago. You know, it went all the way up to 150 at one point, and I was able to trim some because it got too expensive. But I don't know if Blackstone's a good buy at 84. I don't know if BlackRock's a good buy at 570. I don't know if JP Morgan's a good buy at 115. Like I have no idea whether those companies will do as well in the next 10 years as they have in the last 20.
This is awesome. I'm just so impressed with your wealth of knowledge. I hope we can have you back again. There's I'd love to talk for about 3 hours. Unfortunately, I have some time constraints. Bobby, do you got anything else?
No, I just want to say thanks for coming on, Mike. I appreciate
you so much. Yeah.
At the time, man. Much appreciated.
All right. Thank you guys. Appreciate it.
See ya.
Talk to you soon.
Let's get to the trades. I only got about 8 minutes left before I have to cut up, but he knew a lot of shit, didn't he?
You guys want me to drop? I'm still here. You want me to drop off?
Yeah.
Oh yeah. Usually the guest drops off and we just talk about futures, short-term trading stuff that you wouldn't be interested in. Yeah. Okay, I'm glad I didn't say anything bad about you.
Thanks again, Mike. Appreciate it.
Let's get to the trades. What do you got first? You got a crypto trade?
No, I looked at crypto and I looked
because crypto hasn't moved in the last 2 months. It trades damn sideways.
Yeah, I mean, looking at those, you know, in terms of like the time frames that we think about in this particular segment, there's just nothing there for me to do. But I do have, if you look at crypto as a currency as opposed to a 15-year asset, like Mike just schooled us on, I'm selling sterling. I want to sell the British pound.
Good. My trade is to sell the euro. So you go with your sterling one first.
Yeah. So some people were, you know, I got a couple of texts today. Why is the pound rallying? Why is the pound rallying? Obviously, Liz Truss resigned today. We're recording on Thursday this week. Hopefully we'll get this out a day early, but I don't know. We still might release on Monday, but I shorted the sterling at 112.35. And my reasoning behind it is technical, but also there's no good news coming out of the UK. A little bit of the rally that we saw today, again, Thursday, I think was short covering because even a government without basically a short-term future is more stable than the complete chaos we've been seeing. And it was enough for shorts to come in and cover. So at least people now know, okay, we're not going to have Liz Truss. We're still going to have the current chancellor of the exchequer. That was decided, but we got an election coming up. That's more stability than the UK has had in the last few days. So it brought about short covering, but certainly in my view, did not bring about new longs. So I'm going to go ahead and sell that. And this is a really tight trade for me. You know, my stops are usually pretty far away, but on the micros, I sold at 112.35. My stop's 113.30. Usually I'm 2-3 handles away. Not this time. That's only risking $60 per micro. And I've rounded up on this. It's 59 and change, but $60 per micro. And my target is going to be 105.50. That's going to make $491 per micro. And again, I rounded that down, actually. It's $491 and change. So it's definitely good risk reward on this one, but I suspect if I'm wrong, my stop labels me out pretty quickly if I'm wrong.
See, so one of the things I want to underscore is that sometimes we make trades like this, and both my trades last week, I think were like stops were pretty close, meaning that if the momentum's either there or it's not.
Right.
And I have no problem with a trade like that. I think it's a good idea. I have the euro, and it's the same sort of thing too. I thought there was a bit of a short covering rally too. The trend is still lower in the euro. I think if the pound starts falling, it could drag the euro with it. So mine's a stop in trade, selling it at spot 9790. and targeting move down to spot 9650, and then a stop placed above it, spot 9870. So yeah, so 60 ticks on the upside. So no, that's 80 ticks on the upside. So you're risking $100 in the micro D euro to make $1.75. I can't imagine you're going to say, no, I hate that trade when you just said you're going to short the pound, right?
No, I like both of these trades. Again, you're seeing worse and worse economic data from a perspective of weakness, from a perspective of inflation, and the U.S. still kind of holding in. So until these UK/EU economies start doing better, you have to still think that the dollar will do better medium term on it. So I like both these trades.
Cool. My last trade, I'm not sold on at all. It was going to be a micro ES trade. It was going to be for a bounce. I don't love it. I'm basically delta neutral with my core short position and options against it. You mind if I strike that one? Because I've lost the love.
You can strike it. I like your core short position better than taking a shot at it. So those are the two trades. That's it. We're both shorting European Union, UK currencies. I'm good with that.
Yeah, and good. And one thing I will say about equities, I'm still waiting. If I can get a weekly settle in the S&Ps above 38.25 to 38.40, let's call it. If I can get a weekly settle above that, and then any sort of trade above it the next week, I believe the bear will be over. I don't think it's going to happen, but and I know you're going to say that a bear is not over until we make new highs.
Yeah.
I mean, we're heading higher, medium and longer term is my opinion.
That's fair enough. I mean, you're trying to jump in a hot air balloon that's rising, and I don't have an issue with that. My thing is, I still think the fourth quarter will be positive. That's my base case. It'll be positive versus the third quarter's close. And then we get the next shoe to drop, which will be earnings downgrades. I've said it throughout the time we've been doing this podcast. I thought the fourth quarter earnings, the third quarter that we're seeing now, we're not going to be the bad ones. It was going to be this year, fourth quarter, first quarter next year. They're going to be the next leg lower. So, which
might be met with a Fed that's more accommodative at the time too. So it could be a counter. So I got to run. I'm doing Michael Farr's podcast, so we got to do that in about 3 minutes. So I got to run, my friend. I'll see you. Have a good night. Okay.
Talk to you soon.